Northern Oil and Gas, ticker NOG, just delivered their Q2 2026 earnings, and it's a massive revenue beat, though the EPS is honestly a really mixed picture depending on which tracker you're looking at.
Yeah, it's kind of all over the place.
Right. But revenue was an absolute top-line blowout. I mean, they hit $745.24 million, which completely crushed the estimates. Those were sitting in the, $594 to $616 million range.
Well, they blew right past it.
Totally. And management reiterated their full year 2026 targets. So they're still projecting total production of 143,000 to 148,000 BOE per day, with budgeted capex around $850 to $900 million.
And the stock reaction was actually really positive. It popped in after hours and closed the regular session of 3.72% at $21.04, I think.
Yeah, which is pretty notable because they completely defied this broader energy sector pullback. Like, crude prices were tumbling and dragging everyone else down, but NOG just sort of ignored it.
He really did.
Yeah.
But we should talk about that EPS discrepancy because it's fascinating.
Oh, it's wild. It's basically a Rorschach test for analysts right now. Like, if you pull up Zacks, they report an adjusted diluted EPS beat of $1.13 versus a $1.02 consensus.
Right.
But then you look at Market Beat, and they showed that exact same $1.13, but they're calling it a narrow 4-cent miss against a $1.13 consensus. And then, off to the side, GAAP EPS came in at $2.19.
Yeah, the $2.19 is the really noisy number.
Right. So in today's deep dive, we've pulled the Q2 report, the management commentary, and these conflicting analyst notes, because our mission is to figure out how a company managed this massive revenue blowout when half their primary product was literally shut in.
It's a textbook case of why you absolutely have to look under the hood of an earnings release, especially in energy.
Let's start with that EPS discrepancy, because it looks to me like the difference completely depends on how these platforms modeled NOG's, non-cash derivative adjustments and their asset retirement obligations.
That is exactly the core of the confusion, because that $2.19 JAP net income that was heavily distorted by a $156.5 million non-cash mark-to-market gain on their derivatives.
Which is just a paper gain, to be clear.
Precisely. It's just a paper gain based on the fluctuating future value of their hedge book. So when these platforms try to strip out those non-cash items to get the core operating profitability.
The adjusted EPS.
Right, the adjusted EPS. They use slightly different algorithmic models. Some factor in certain transaction costs differently, or they handle the timing of hedges in another way.
So for you listening, if you checked your portfolio and see a miss on one site and a beat on another, don't panic. Whether an algorithm calls it a 4-cent miss or an 11-cent beat, the underlying truth is that the physical cash generation engine here is just running incredibly hot.
Exactly. Institutional investors look straight through the paper gains and just zero in on the cash.
And you don't get a $150 million plus revenue beat without pumping some serious volume. So let's break down how they got these top-line numbers. Total average daily production hit almost 146,000 BOE per day, which is a 9% year-over-year increase.
Right, but the underlying mix of what they pulled out of the ground is heavily skewed.
Yeah, it's totally inverted. Oil production actually fell 11% to about 68,000 barrels a day, but natural gas, that just surged 35% to a record 464,330 MECF per day.
And to understand why those volumes inverted like that, we really have to talk about the Permian Basin and associated gas, because this is where energy markets get really counterintuitive.
Yeah, the shut-ins.
Right. During the quarter, NOG had about 7,000 BOE per day of shut-ins, mostly on their Novo assets down in Culberson and Eddy counties across April, May, and June.
And a shut-in just means the operator literally goes to the wellhead, caps it, and completely stops producing. But crude prices were pretty strong then, so why would a company stop pulling valuable oil out of the ground?
Because of what comes up with the oil. In the Permian, most of the natural gas is associated gas. It's basically a byproduct of drilling for the crude.
You can't just extract the oil and politely leave the gas down in the rock.
Exactly, it comes up together. And earlier this year, the Waha Gas Hub, which is the pricing benchmark for natural gas in West Texas, it went deeply negative.
Which is wild to think about. Imagine running a business where you literally have to pay people to take your product away. Because the pipelines were so full, producers were paying buyers to take the gas off their hands.
Right, and flaring just burning off the excess gas is heavily restricted.
Yeah.
So even though the oil is really valuable, the financial penalty to dispose of that associated natural gas was so severe that the wellhead economics turned completely toxic.
They were losing money on every barrel.
Exactly. So operators just made the call to shut them off entirely, until the gas pipelines cleared up.
Which really brings up a critical vulnerability in NRG's specific business model, right? Because they're a non-operator. For anyone unfamiliar, NOG doesn't own the drilling rigs. They don't hire the crews. They just buy working interests in the wells and let companies like EOG or ConocoPhillips do the actual drilling.
Right, they just provide capital.
So isn't being a non-operator basically like being a passenger in a car where the driver suddenly slams on the brakes? Like, you have zero control when a third-party operator decides Waha pricing is too bad and just shuts in the well.
You're hitting on the primary historical critique of the non-op model, for sure. You're riding shotgun. If the operator shuts the well in, your cash flow from that asset just stops instantly.
You can't override them.
Nope. However, this specific quarter actually proved how resilient Northern's evolved version of this model is.
But wait, their Permian asset is one of their biggest cash generators. If 7,000 barrels a day get capped, it shouldn't matter that they're a non-operator. That revenue just vanishes. How did that not totally tank their quarter?
Because management hasn't just placed a bet on one vehicle. They've essentially placed bets on 5 different cars in 5 totally different geographic basins to mitigate this exact risk.
Oh, so the diversification saved them.
Exactly. While the Permian car was forced to slam on the brakes, their Uinta Basin assets in Utah totally outperformed. They beat internal estimates by 11.5%.
Wow.
And concurrently, their Appalachia assets, which are almost entirely natural gas, they hit absolute record production volumes.
So since they had a massive surge in natural gas from regions where the pricing wasn't negative, they could offset all those oil losses in Texas.
Precisely. That regional multi-basin model is the only reason they managed to grow total production by 9%, even with a major disruption in their most important oil basin.
So let's follow that cause and effect to the balance sheet. Since they were forced to pump 35% more natural gas, and we know natural gas is historically way cheaper than crude oil, you would naturally expect their cash margins to crater.
Right.
But looking at the financials, the exact opposite happened. Free cash flow just exploded to $159 million.
It's a phenomenal margin story. That's a 26% increase year over year and a staggering 424% sequential jump from Q1.
424%. That is crazy. And adjusted EBITDA hit $401 million, which is up 17% sequentially. But to really understand that, we need to dig into how they price their product because they have a super aggressive hedging program.
And they're active, yeah.
Their unhedged realized prices, what they'd get selling on the open market, were strong, like $50.61 per bow. But their settled derivatives actually cost them $6.51 per bow.
Right.
So that resulted in a net cash hedge drag of $86.3 million for the quarter. Basically, losses on crude oil swaps offset their gains on gas hedges.
And this is where retail investors really have to grapple with how to view corporate hedging.
Yeah.
It is perpetually a double-edged sword. Like an $86.3 million cash drag is painful.
Yeah.
That is pure cash that could have flowed directly to the bottom line if they had just ridden the spot market unhedged.
So if you're looking at your portfolio right now, you might be wondering why you'd ever tolerate an $86 million loss. It feels a lot like buying incredibly expensive flood insurance during a prolonged drought.
Yes, exactly.
You know, it really stings to write that premium check when the weather is beautiful and unhedged commodity prices are so high.
That's the perfect analogy. You don't buy flood insurance for the sunny days. You buy it so that when a hurricane actually makes landfall, you don't lose the entire house.
Right.
Northern uses hedges to protect their baseline cash flow. That floor ensures they can fund their capital expenditures and, most importantly, pay their shareholder dividend, completely insulated from macro commodity shocks.
And the only reason they can absorb an $86 million hit without completely flinching is because of their cost control on the ground. Their lease operating expenses, their LOE, was extremely tight at just $9.59 per bow.
Yeah, when your fundamental operating cost is under $10, you can absolutely afford to pay for that expensive flood insurance and still generate premium cash margins.
So management is sitting on $159 million in quarterly free cash flow. That capital is just burning a hole in their pocket. How are they actually deploying it? Because the outline shows some major M&A moves.
They were highly acquisitive this quarter. The headline move is definitely their strategic expansion into Canada. On June 1st, they officially closed the Duvernay light oil joint development in Alberta.
Total consideration for that was $262.1 million. They paid roughly $237 million Canadian in cash, plus 3.7 million shares of NOG stock. But why Alberta? Like, what makes the Duvernay Basin worth going to a totally new country for?
Well, you look at the Duvernay because it offers characteristics that are just becoming harder to find in mature U.S. basins. First, they acquired a 25% undivided stake in roughly 78,000 net acres.
Okay.
And the rock there yields a really high percentage of liquids, which are way more profitable than dry gas. Second, the regulatory environment and the infrastructure bottlenecks are totally different from the Permian.
Less congestion.
Exactly. And most importantly, the economics are stellar. They're expanding their total addressable market into a high-quality basin where cash costs are under $7.50 per boe.
So it's highly accretive to their bottom line right away, but they didn't just make one big Canadian purchase right away. They also closed 30 separate ground game deals across the U.S. for about $44.7 million.
Yes, adding another 2,300 net acres.
So by executing 30 tiny micro deals for just $44 million, they're essentially picking up these highly lucrative scraps that massive operators leave behind, just bolting on prime real estate at a fraction of the market cost.
The ground game is exactly where a non-operator can really flex their advantage. They don't have to worry about moving a physical rig onto those tiny acreages. They just buy a working interest in a small sliver of land adjacent to a planned horizontal well.
So when the operator drills through it, NOG just gets their cut.
Exactly. It is incredibly capital efficient.
And while they're aggressively buying acreage, they're also aggressively buying their own company. They maintained the 45-cent quarterly dividend, but they also repurchased 2.95 million shares in the quarter at an average price of around $20.37.
That's right.
Which means they retired about 3% of their entire outstanding float in a single quarter. And then the board authorized a $150 million increase to the repurchase program, taking the total capacity up to like $243 million.
If we view this through a capital allocation framework, management is executing a highly calculated arbitrage strategy here.
So break down the mechanics of that arbitrage. How are they exploiting the market?
Well, CEO Nick O'Grady was very explicit about this in the earnings release. He pointed out that public equity markets are significantly undervaluing their assets compared to what those exact same assets would fetch in a private market sale.
Interesting.
There's a structural disconnect. So management is looking at their immense free cash flow and concluding that the absolutely best return on investment is to buy their own cash-generating assets at a massive discount by repurchasing their stock at $20 a share.
Okay, so they used 3.7 million shares as currency to help buy the Duvernay asset, but then immediately turn around and use their cash flow to buy back roughly 3 million shares in the open market.
Yes.
They're essentially neutralizing the equity dilution from the acquisition while still funding low-cost inventory. That's honestly a masterclass in exploiting the gap between public sentiment and private valuations.
It signals incredible confidence. They're basically telling Wall Street, if you won't give us a premium valuation, we will happily just buy ourselves at a discount.
I love that. Let's pivot and look at the risks, though, because no quarter is perfect. We've talked about the successes, but looking under the hood of this first half, what are the genuine hurdles for the second half of 2026? Because management reiterated their full-year guidance, which implies they are extremely confident.
The primary hurdle is absolutely going to be their oil volume execution.
Because they left their annual oil target entirely unchanged at 71,500 to 73,500 barrels per day. But as we discussed, Q2 oil production was really light at just over 68,000 barrels a day due to those shut-ins.
It just comes down to basic math. If you spend the first half of the year producing significantly under your target, you require a steep, sustained acceleration in the second half just to hit your annual average.
Right.
And NOG is relying heavily on two distinct catalysts to make this happen. First, they need the full return to those Permian shut-ins. Management noted that Waha pricing was beginning to normalize, so operators were bringing wells back online.
Okay.
And second, they have 3 deferred turn-in lines that must come online in the third quarter to organically boost those volumes.
And for context, a turn-in line, or a TIL, is the final stage of the process. The well is drilled, fracked, and turning it in line means they literally open the valve to let the hydrocarbons flow into the sales pipeline.
Yes.
So if those get delayed, the revenue doesn't happen.
Correct. So if those specific TILs face further delays or underperform expectations, hitting that annual average becomes geometrically harder.
I have to push back on management's confidence here. Isn't leaving the oil target completely unchanged a massive gamble? Like, if Waha gas pricing craters again in Q3 and natural gas infrastructure doesn't just magically double its capacity overnight, those Permian operators are going to slam on the brakes again.
They will.
And if that happens, NOG is going to completely miss its second half oil targets, and Wall Street will ruthlessly punish them for holding to a guidance they couldn't physically control.
It is a significant gamble, for sure.
Yeah.
But it's important to recognize they do have line of sight on new infrastructure. There are major new pipelines, specifically the Matterhorn Express pipeline in the Permian, scheduled to start taking commercial gas later this year.
Okay, so relief is coming.
Right. Management is betting heavily that the structural bottlenecks causing the negative pricing are permanently easing. However, and this is a big however, pipeline projects are notoriously prone to delays.
Always.
If Matterhorn gets pushed back, you're absolutely right. The operators will shut in the wells again to avoid flaring penalties, and NOG's targets will be in severe jeopardy.
And while we're monitoring risks, we also need to keep an eye on their leverage. Pro forma net debt to adjusted EBITDA is sitting around 1.8x right now, and management stated they are targeting getting that ratio under 1.5x by year end.
Right.
Now, 1.5x is sort of the magic number for E&P companies right now to secure credit rating upgrades and guarantee dividend safety. With $159 million in quarterly free cash flow, paying down that debt seems very doable, assuming oil prices hold up and they don't go on a massive, unbudgeted M&A shopping spree.
It's totally going to require strict capital discipline. They have to balance funding the new Duvernay development, executing their stock buybacks, and paying down debt simultaneously.
A tough juggling act.
It is. Generating that level of free cash flow gives them the rare flexibility to do all three at once. But any sustained drop in macro commodity prices will squeeze that flexibility very quickly.
All right, so let's summarize the operational tension here. NOG delivered a monster revenue quarter fueled by record natural gas volumes. They proved their multi-basin model actually works when their primary region gets kneecapped by negative pricing.
Yes.
And they are generating so much cash, they're simultaneously expanding into Canadian rock and buying up their own stock. But they absolutely have to prove they can ramp up oil volumes in the second half, and they need Permian pipelines to cooperate to hit their targets.
I think that captures the reality perfectly. They have built an incredibly resilient, diversified financial machine, but at the end of the day, they are still tethered to the physical realities of pipeline capacity and third-party operators.
For sure. Well, if you're looking to stay on top of how these complex earnings reports translate to actual market movements, make sure you hit follow on the deep dive. We bring you daily, no-nonsense earnings coverage just like this to help you cut through all the financial noise.
Yeah, make sure you follow.
But I want to leave you with one final provocative thought to mull over. We spent time unpacking how NOG management is deeply convinced that the public equity markets are undervaluing their asset base, right?
Right.
They are so convinced that they're aggressively buying up their own stock at $20 a share to exploit that arbitrage. If this cash-generating five-basin model is truly as resilient and undervalued as management believes, at what point does a larger E&P player, maybe a super major, looking for capital-efficient acreage, simply decide to acquire NOG outright to get their hands on that entire inventory?
It's a great question.
If the public market won't price it right, someone in the private market or a massive competitor just might. It's a structural arbitrage just waiting to happen.